You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Remembrance Day. It's important to remember where we're coming from and to remember the sacrifice that people made to make sure that we live in a better place today, or at least they tried to make us in a better place, right? Today's talking about being in a better place. I want to offer you 5 rules to let go of a loser. A lot of question that I've received as of late were about BCE. You already know my stand on that. At Dividend Stocks Rock, it was downgraded actually at the beginning of 2023, so almost like a little bit more than 18 months ago, warning investors that it was not looking good, and then I've made several calls on that. But today I just want to go like broader, but to a broader range, but still keep BCE in mind throughout this quick show. So the rule number 1, that is always the thing that I always look at when it's time to let go of a loser, is I evaluate metrics, not stock performance. A stock could be down, a stock could be up, but what really drives stock price for the long haul is data. So if the business is making more and more money, eventually the stock price will catch up. If the company is not making more money, well, you know what? It's going to be very hard for the stock price to go up because there's no justification here. So long-term vision will require having solid financial metrics. Moving on to rule number 2, your investment thesis must be backed by those financial metrics. Again, do not think that everything's going to be fine or that just believing in unicorn is going to save the stock that you have, or, oh yeah, management's going to turn things around. Those are not plans, right? Those are just like hopes, and hope is not an investing strategy. So if the story you tell yourself is not backed by financial numbers, it's like telling yourself that you're going to lose weight while you don't modify anything in your daily habits. So you don't do more exercise, you eat more of the same, and you just think that, yeah, well, I used to be an athlete in my 20s and I used to run a lot and I was really good at sports back then. So of course I'm going to go back to that shape and lose weight. Well, if you don't do anything, which would be the metrics, so if you don't play on the metrics, the story you tell yourself that you're going to lose weight is not going to work. You have to have metrics that will show you what's going to happen going forward. Super important. The third one is probably the most obvious, but I have to highlight it because that helped me cutting my losses like faster and stop the dragging and the dilemmas. Is I sell whenever there's a dividend cut. Hopefully I did not suffer that many dividend cuts in the 14 years I've been a dividend growth investor. So since 2010, I focused my portfolio solely on dividend growth investing. I got some, of course, I'm not perfect. I made mistakes, and I each time I paid the price, but at least I was able to move on right up front and then just buy something else with the remaining money. And you know what? With all the dividend cutters that I had in my portfolio and that I sold all like up front, none of them came back strong and generated tons of positive returns. So while the hope of getting your money back short term is like almost impossible one way or another, for the long run, every time that I've moved my money away from a dividend cutter and invested in another great company with solid financial metrics, that was a success. I made 2 exceptions of keeping two companies after COVID because they cut their dividend, and I thought, well, it's not because of their it's not because of they were struggling, but rather because the COVID forced the lockdown. That was CAE and Disney, and both of them I eventually sold them anyway. So I probably should have sold them right up front. I kept them, didn't lose money, didn't make money. I just had them as a drag, as a reminder of dividend cutters in my portfolio for a few years, which actually has not been a positive experience in my opinion. So I should have just sell them anyway, let them go and move on. That would have been better even. So Speaking of avoiding dividend cutters and having clear rules to build your portfolio, I will host a great webinar called Dividend Income for Life. Last year, I did that webinar. Over 2,000 investors saw that webinar. So that's crazy, right? So in that webinar, we're going to talk about the myth of high yielding stocks. We're going to also talk about how you can find high quality companies. I will provide you with a full example of a retirement portfolio, and also the last part that is probably the most important one, how you can create your paycheck when you retire. So you can register at moosemarkets.com/webinar. So moosemarkets.com/webinar, or just go in the show notes. The link is there, and I'll see you on the 28th. Of course, there will be a free replay for everyone. Number 4. So already we have talked about looking at financial metrics, not the stock performance. We have looked at matching your investment thesis, so the story you tell yourself, with data. We talked about selling on dividend cuts, but there are like two other rules that I want to discuss today. The fourth one, what is next? What is next in the sense that, like, what management is doing? Do they have a plan? So they probably, like, if a stock is down, chances are revenues are slowing down or stagnating. Same thing with earnings. Probably that the dividend is shaky a little bit. So long story short, the numbers, the financial metrics are not as strong as they were. So I am able to be patient, and we're going to talk about how long you should be patient as rule number 5. But here's the thing. You need to see some improvement. You need to see a plan. You need to see what management is doing quarter after quarter to do something else. Going back to my example with Bell, BCE on September 18th announced that they were selling their stake of MLSE to pay off debts. That was the press release. Management said, we're selling an asset to pay off debt. 7 weeks later, not 7 months, not 7 years, 7 weeks, on November 4th, they say, oh, you know what? We're going to buy another asset and we're going to get into more debt to close that deal. So they went from, we're going to clear off our balance sheet by selling assets, to we're buying more assets and we're getting into more debts. Do you really think that management did not know that they were about to buy Ziply, and they were in negotiation about to buy Ziply on September 18th when they announced that they were paying off debt? I mean, if they were not aware of their own strategy, and right after selling MLSE stake, they just said, oh, let's buy something else, and they went on Marketplace to find another business to acquire. Really? Is this serious management here? That's not. And this is one thing. I want to look for coherence. I want to hear about management and a clear plan. Maybe they're going to fail with their plan, but when they're telling me that they want to pay off debt and the next morning they're actually getting into more debt to buy more assets, that doesn't sound like a plan. That sounds like a guy trying to save his job and doing some improvisation in the meantime. So how long should you be patient? That's my rule number 5. How long to wait? I don't like to be trigger happy. I'm trigger happy on a dividend cut, but that's the only moment that I sell up right away. All the other things, I will evaluate metrics. I will look at my investment thesis. I will look at management plan, and I will wait. For a business that I've made a lot of effort analyzing and determining it was a good fit in my portfolio, I am willing to wait 2-3 years. 2-3 years, not that long, actually. When you think about that, I'll be investing. I started investing in early 20s. I'm going to be ending my investment career when I pass away, maybe let's say 85. So that means 65 years, 60 years of investment. So waiting 2-3 years, not the end of the world. You want to give a chance to management. I mean, things happens. You're not always at your best every day at work. You're not always at your best in your marriage or with your friends, right? So you need to have some leeway here. So I'm willing to wait 2-3 years, but I want to look for a plan. I want to look for some improvement. And if I don't see that, well, then I'm going to become more impatient. On the other side, if I see that things are getting better and better, well, I am okay to wait a little bit more. TELUS, for example, just to make the comparison with BCE, and because TELUS in my portfolio is in that range right now in my portfolio. So it is definitely underperforming the rest of my holdings. I'm still making money because I've been a long time shareholder, But right now, what I see metrics that are improving, and I see that they're getting out of this hole. So because of that, I'm still patient. Of course, if at one point they fail, well, it will be the time to kiss it goodbye. But right now, I'm still positive on it. Maybe I'm going to be right. Maybe I'm going to be wrong, but I must follow those rules. So, hey, that's a wrap up in 10 minutes. That was pretty cool. So, all right, Moose, that's enough for today. We're going to talk again tomorrow. I'm going to review some earnings this week, probably like Brookfield that just reported their earnings as well. For TELUS and Bell, I'm not too sure I'll have time to do them on this podcast, but I will discuss them at DSR during the webinar that we have, private webinar this Wednesday. So, all right, Moose, take good care. We're going to talk again tomorrow. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.